All right. So not a ton of new fundamental information to go through this week, but I'm going to hit the highlights real quick. And then we're going to turn to some supply and demand stuff, and then we're going to turn straight to the charts. All right. So if we're riding a bicycle and the frame of the bicycle is supply and the wheels of the bicycle are demand, what we're going through is a period of time where the wheels fell off the bicycle. And so we can't go anywhere again until we put the wheels back on. Um, and that's exactly what has transpired over the last 90 days. And the wheels completely fell off. Now, there's two things that made that happen, right? Number one is ethanol, oil imploded, ethanol imploded. Over half of our ethanol production is currently shut in, and there's trade tension, and people are debating whether or not China is going to perform phase one. So there's questions about what the demand forecast is going to be, and I will say that yesterday. Uh, uh, there's a lot of rumors that a lot of the plants that have shut down across the Corn Belt have started bidding for new crop corn. They had went to no bid. They weren't originating anything, and there's rumors that some of them have started bidding again, which would be obviously a very welcome thing. So pay attention to that. That could really start to turn things quickly. And then secondly, Mnuchin is saying that China will perform its phase one deals and they fully expect them to. So the rhetoric going back and forth between China and Washington continues. Uh, who knows where that's going to go? But there's a couple of other points I think that are really important as to whether or not China is going to perform. And the biggest one is down here. Pay attention to what's happening in Brazil, because at the present moment, remember, they have not sheltered in place, they have not social distanced. Currently, they have the highest per capita infection rate on the planet, and they have the poorest healthcare on the planet. So you have a much higher death rate, and you've got issues starting to develop about whether or not they should continue to function. So if those ports shut down in South America because of the virus, then that leaves us as really the only primary supply for the rest of the globe. And that could turn really bullish for soybeans really, really quickly. So pay attention to this set of headlines that's unfolding in South America, because we don't know for sure what's going to happen. The other one that's big, and if you pay attention to oil, oil has doubled in value since last Tuesday on the front month chart, and the spreads have started to come in too. We think in terms of carry in the grain markets, right? And in the grain markets, if the front month is trading higher than the back months, we call that an inversion. And typically that's because we have a supply problem, or a really, really big demand story that's pulling all that corn into the front side. But we're trading at a carry, and we have been for a long time. Oil's kind of the opposite. It typically trades at what we would call an inverse. They would call it a backwardation. And as oil imploded, it went to a contango or a carry. And now you're starting to see that contango come out of that market because the front month is rallying harder than the back. So pay attention to oil, because I think corn and ethanol clearly are tied to it. It's going to continue to move. So don't sleep on the fact that oil doubled in value in a week, and the trend seems to be more demand. Now, just the last time I checked was about 10 minutes ago, and oil was posting a reversal back to the downside. So I expect corn to kind of trade with that. Another headline that caught my eye is in the Wall Street Journal today. Grand Island, Nebraska is on the main section of the Wall Street Journal today for becoming a major hotspot, and really basically for saying we can't shelter in place because we can't build combines from home, is what the mayor said. And so that has, on a per capita basis, they have a much higher infection rate now than New York does. And uh, I just don't think it's ever good when a Midwest town is put in the Wall Street Journal. So pay attention to that. Okay, want to turn for a minute to the corn balance sheet, because there's lots of issues, lots of things going on in the corn market. So what we want to do is look at what the balance sheet might look like if and what the ending carryout might be on a moving forward basis. So I'm going to walk through this real quick, and we're just going to play some what if games here, right? And this is the most recent report from the USDA. These are some assumptions that we make. If we plant 97, 95, or 94 million acres, and if we harvest 91% of those acres, this would be how many acres we would harvest. Depending what our yield is, I've got 3 different yield models here. This is trend line. This is a little bit better. This is last year's yield. Here's our beginning stocks, what they say that we have. And this is end use. So this is what the USDA has said the end use was in April. Guys, if we do this, this points out to a huge carryout. I mean, that's just apocalyptic. Surely that won't happen, but you just don't know. And the more guys I talk to, this number is more likely than this number, than 94, because crop insurance is so good. So virtually everybody I talk to, they're not shifting acres to soybeans. They're sticking with corn, and they're just kind of hoping that crop insurance bails them out. And oddly enough, if you really dig into the math, the most profitable year that we could have is if, or that a corn farmer might have, would be if corn were to implode all the way to $2, because that would maximize crop insurance payouts. It would maximize LDP payouts, any other government relief that would come. Plus, you get the benefit of any cash sales that you make. So this case is not unrealistic, but that carryout is very scary. Now, this just holds demand the same. If ethanol continues to implode, that demand number is going to go down. So let's look at the bullish case, because that's way more fun, right? The bullish case is we don't plant at all. We make some few changes. We get into some weather issue that holds our yield down a little bit. Not a major issue, but gets hot in July and takes the top end of that yield off a little bit. But then China steps in and buys 800 million bushels of soybeans, and we recover ethanol just a little bit. If we can achieve that, then we might be able to come in under 2 billion bushel carryout. And that's not bullish, because a 2 billion bushel carryout is what we've had for the last several years, and it really looks like that value could be at best in that 350, 380 range that's in there. So we've got to do something more than this bullish case in order to seriously impact that carryout. Now, what could it be? I'll show you what this number looks like. If China buys 800 million bushels, and if we go back to ethanol grind at a full rate, and let's add 500 million bushels to that, now you're starting to talk a little bit more bullish, because now you're down to 1.4. If we get into a significant weather issue with a planted acreage of only 94, and significant would be like a 2012 type event, and let's say that took us down to 155, now you're talking a bullish case. Now the odds of that happening are basically zero. I mean, it's just a very far-fetched deal. So I think the conclusion from this is that carryout's going to be huge. It's going to be far bigger than we anticipated it to be in January, and the upside is going to be extremely limited. What this tells me as well is that basis is at risk. If there is too much corn and we don't have a lot of demand for it, then basis could get really soft or really wide, even if futures were to hold in this 340, 350 range, as the market redistributes those bushels across the countryside to where the demand actually is. Don't underestimate the power of basis. You know, we did this last year. We had lots of low test weight corn. We had issues in certain spots, and rather than the futures market rally to accommodate that late planted low test weight stuff, the basis did all the heavy lifting, and it did that by keep maintaining a strong basis or a high basis on the good corn, but sharply discounting the low test weight corn in different places. So it rerouted bushels in some very counterintuitive ways to push the good bushels to where they needed to blend out with the bad in order to satisfy the demand side. So basis is a very important piece of the puzzle, and something that you do have risk on. So if you're a farmer, really the only way to manage that risk is to sell it. So we've been pricing quite a bit of basis, not at great levels, but at levels that are livable. You know, option 10 under, just levels that get our risk out. Because if we go back to 2016 basis, we have 50 to 70 cents of basis risk if we get too tight. So my thought has been, get that basis risk out of the off the table. Just set it, because a known number is easier to manage than a guess. Let's not just hope for better prices. Let's really manage that risk. So we've set basis on a lot of stuff, and now we're just worried about the future side. So here's what corn is doing. This is July corn. We'll turn to December here in a minute. I've marked the day oil imploded, and I've marked the day oil reversed. So if you can see, corn is trading right with it, right? Except we're not rallying the way oil has so far, and that's to be expected with our supply situation. You know, we're really filling up that pipeline, and there's a lot of unknowns about when ethanol might turn around. So corn has traced this bottom, but the longer it fails to really rally, the more likely it is going to challenge or even break these lows. So the downside risk in corn is still very much alive. I don't think anybody's surprised about that, given the balance sheet we just looked at. And a rally is going to be very muted. So if we look at December, December corn is really vulnerable. It may work sideways here for a little bit longer, but I'm a little worried that December corn is not going to get much uplift because the fundamentals are so bad. Planting progress is so good. We're just going to trade sideways, maybe a little bit higher through May and into June. And as soon as we get some confirmation that the weather is going to hold and that we're not going to burn this crop up and that it's going to pollinate, then I'm just, you know, the floor could just fall out from underneath this thing and crater. So risk is very much alive in corn. If your downside is, if you're a farmer, your risk is to the downside. It is not up, it is down. And so, and you've got two things to manage. You've got basis and you've got flat price. And you can manage your basis by doing forward contracting, and you can manage your downside by cash sales, taking a short futures position, or by buying puts. And you can do that through options accounts. There's ways to manage that risk, but it's very much alive and very much alive and well. And that's even with China buying 1 billion bushels of corn. It's unfathomable that much export demand wouldn't change the picture very much, but it really is a risk. And when I see these divergences and these 13s and all these bullish things fail to trigger, tells us that something much more bearish is unfolding, and it could get tight. Okay, let's turn to soybeans. I'm talking too much here on other stuff, so let's turn to beans. Beans are continuing to consolidate and trading in this range from about 855 to 835. The market's just paused and it's waiting on something to tell it what to do. It feels like it's either waiting on China to step in and buy all the beans, or which would be Brazil shutting down, or it's waiting on corn to implode so it can go with it. Nobody knows how many acres shifted from corn to beans, or if any did at all. Nobody has a clue about that, and we won't know for a period of time. But kind of like corn, the longer we sit down here, the more likely it is that we challenge these lower levels here. If we dig in and look at the real short-term time periods and trade action off of this move, it doesn't look great. We need to turn higher and take this high out very quickly, or this is going to turn into a negative chart pattern. And if these lows right here at 828 fall, then honestly, $8 is your first target on soybeans. So the technical action isn't doing what we wanted it to do, which is bottom and find support. It's acting very, very weak, and the uncertainty is growing in the market. So I'm very concerned that we are going to take another leg to the downside, and we want to be cognizant that that is a possibility. All right, Kansas City wheat. This is the market that should be rallying, right? I drove around a little bit yesterday, and the wheat looks terrible. It's thin, it's light. It just looks bad. I know some of you still have some good wheat, but the wheat to the north is not great. And my understanding is, as you get further west into Kansas, it gets worse. So wheat's been tracing this huge range here. This is a 40-cent range, consolidating from late March, and it's been trading bullish fundamentals, dryness in Europe, dryness here, freeze damage here in Kansas, and strong demand from world governments that want to build stockpiles from the virus. So you've got bullish demand fundamentals, you've got bullish weather fundamentals and supply side things, and we're still not really rallying it. So we've consolidated now this is day 8, consolidating at this 480 level. And we've been talking that a break below this trend line. We've tested it a few times, but this is bearish below this. If we break and close below about 478, then that turns this chart pattern bearish. Now, when you're trading in a range like this, a general rule of thumb is that a breakout of the range will equal what the range was. So a 40-cent range, a breakout above or below would imply a 40-cent move either side. Now, whether you count that from this 877 level, or you count it from this absolute low here at 469, that's up for debate. So wheat is really not responding to the fundamentals, which gives us a lot of concern. So hopefully things turn and we get a bid and we can get some higher prices. But the downside risk in wheat is growing, even though emotionally and intellectually that makes 0 sense to us. But we cannot ignore a downside breakout of that trading range. So stay tuned to wheat. Again, the downside risk is growing, so if you have that risk, it's probably prudent to find a way to manage it. And with that, I will let you all go, and we will talk to you next week. I hope it's great.